Well, hello everyone. It is half past, and good morning and good afternoon to those everyone in Canada from coast to coast. We're going to be having a 1 hour session today. You will, by registering for this, since you have registered and you have your email and when you entered all your information, we will be issuing your CE credits in the coming weeks. So be assured that will happen. I'll remind you at the end as well that will happen as well. And yeah, we will get started. Uh, if you do have any questions, just make sure you do put it in the Q&A and just type them in. Everyone else will be on mute. I see that some messages are coming up saying good morning. So hello, good morning. So that's either Alberta, I guess Saskatchewan's even, and BC at this point. So hello. And of course, good afternoon to everyone on the other side. My name is Paul Grunsel. I'm Director of Business Development for SSQ. I am in Calgary. I'm in Alberta. So I trust that everyone is in this time staying safe and enjoying some time with their family and taking time for themselves and during this pandemic. So pleased that we could have these seminar series SSQ has been putting on the last couple of months. And today I have the privilege of talking about SSQ Universal Life. So the agenda today, we have one. Start off what's called a mutualist company, right? So that means they want to kind of start a company that does some good in the world. And so that, of course, evolved over the next 75 years into an insurance company. And but we try to adhere to those core values of integrity and respect and social commitment. So we really do keep that in mind at SSQ. Where we are right now, fast forward to 2020, we are the sixth largest insurance company in Canada by premium volume. The premium coming from group and individual insurance, investments, and general insurance. We have a sales teams to help you out as independent brokers across the country. So feel free to reach out to your wholesalers and your sales teams, and we can definitely help you better understand SSQ, even through your MGAs and who you do business through. They, of course, can have a lot of information about us. One thing to let you know about SSQ is that we did announce in January that we are merging with La Capitale, so another mutual company. So we will be forming the Canada's largest mutual company moving forward. Now with COVID, it kind of didn't halt things. We're definitely going through with it. It's all going to happen. But it just we had this big rollout plan, but we're working on that, and stay tuned for that. That's exciting for us. Two companies, about the same. They are the same size, merger of equals, and more resources. Basically, better resources for you, the broker, and better products, and in the end, better coverages for you and your clients to have. So we're excited about that moving forward. All right, on to Universal Life. So let's take a look at the overview. What is Universal Life? Well, what is the marketplace? Well, over the last 20 years, over $7 billion have been put in place. So definitely it's something that brokers are using, that financial advisors, that clients see value in. It's one of those tools in your toolbox that you can use. So we're going to explore how to better understand that, to see as to why. So our objectives here are, why are these advisors using it? Why are clients seeing value in it? And we're just going to have a nice discussion about it and see if we can find the value piece. Now, keep in mind, YRT, UL, whole life, even level UL are not suitable for everyone, right? So we have to put up our disclosures on that. It's just, they're all tools that we have for our clients to find out, to fit their needs and their objectives to meet their protection needs. Okay. Big picture for Universal Life, it is flexible. So super flexible. So it can just be regular life insurance, right? It can be income replacement for corporate business or individual. It can just be the life insurance piece for your clients. Definitely something to look at for that. You can also have a funding, an investment part of it, a savings component to it, of course. And of course, you can use that for retirement or other goals as well. And the third piece, of course, you can use it for estate planning by passing wealth to the next generation tax efficiently. So it's a great tool for estate planning. We're going to go delve into some of those pieces as well. And it gets flexible. You can start off with the income part and it can morph into the others. So super flexible, super transparent, and that's what I like about it. And great value. And why? What is the great value? Why is there value with UL, particularly yearly renewable term? Uh, is because of the cost of insurance. It drives everything. So if you don't take anything away from today, I want you to take away that the cost of insurance drives this product and drives the value piece for UL, YRT UL. Because a new LICAT regime came in, and that regime, of course, LICAT stands for Life Insurance Capital Adequacy Test. And what it does is measures the capital requirements needed for insurance companies. So put on reserve to back up their promises, hence life insurance payouts, those sorts of things. So really, if the longer the term of the guaranteed product, the more negatively it was impacted. So the LICAT needs are driving up costs, especially if you're looking at level cost of insurance. So you may have already noticed that some companies have actually started to increase their level cost of insurance premiums and having them increase. So why are we looking at YRT today? Well, because the level cost of versus level cost of insurance. Well, if you do yearly cost of insurance, so yearly renewable term, or some people call it annual renewable term, smaller reserves are required for this product, and that's where the key value for YRT is and UL. So, okay. If you're selling YRT, like I said, you can. It's all in the flexibility, so you can minimum fund for income replacement, max fund for retirement, or as the estate planning pieces. So this is what we're selling: flexibility. It will evolve over time with you and your clients. Set it up. Okay, what is the structure? The universal life structure. I think we've all we've looked at something like this. I remember if you're taking your LLQP, you first came across this. If you've taken many courses for CE credits, you come across this too. So really, there's three components to a universal life versus what we consider a term, and we have to get our clients to understand this because term is like, yeah, I'm paying for something and I get this benefit. Well, this one's a little different, right? It has an extra component to it. Yes, you're going to pay a premium on a monthly basis or annual basis, or for a set amount of time as well. It goes into the investment fund, the accumulated savings account. So this bucket, I'm going to refer to this bucket of investments throughout this presentation. Out of that bucket of investments, the investment funds are the deductions for the monthly cost of insurance and a fee as well. I'll talk about the fees for the investments as well in there too. So really, you make your deposit, it goes into a savings account, and then you pay out your monthly cost of insurance. And with YRT, of course, it's lower at the beginning, right? So what is the cost of insurance? Well, there's two options for you. So of course you get the YRT, which is a yearly renewable term. So as you age, as you're younger, it costs less, but it goes up over time. With level, it stays level for your lifetime, right? So the key benefit here is that if you choose level, then you know what your cost of insurance are for your lifetime. If you choose YRT, you still know what it's going to be for your lifetime, just you know that it is going to go up over time. So at the early days, you're actually paying a little more for your insurance costs to not get the same benefit. Make sense? Now to the other aspect of this, and we actually like to confuse, like that we have these same terms here. So we actually have the death benefit option as well with universal life. You can choose an increasing or a level death benefit. And that previous screen I showed you before with basically YRT is increasing and level to T100. Well, that's just the cost of insurance we're talking about. So we use the same terms. Of course, for a death benefit, we use the same terms, increasing and level. So what it does, increasing, if you want an increasing death benefit, so when someone passes away and it pays out, you can either have the amount that you're insured, so that here, I'm gonna, yes, there we go. So the net amount at risk, so this could be a $500,000 policy or $1 million policy, that's the amount at risk. Anything going into that investment bucket also gets paid out upon death. For the level amount, that $500,000 policy or $1 million or 10 million policy gets paid out until that accumulation fund goes past it. You can still access this fund for everything in life, but that's just the two options that you choose for your clients. The other option that we have when we're selecting for universal life is, what do we want the insurance amount adjustment to be? So what is an insurance amount adjustment? Well, it really refers to your, say, your $500,000 policy. If you want to put a lot of money into that, so if you're Bill Gates and you have a $500,000 policy and you want to throw your $10 billion into that policy, well, unfortunately, the tax benefits aren't. You're gonna, there's certain rules that you can't go over certain dollar amounts. So if you're going to overfund, you can choose an increase or increase decrease, and that will actually increase your $500,000 policy by 8% each year. So at least you get the most bang for your buck into that investment bucket. Okay, and the increase decrease actually allows you to put money in early and increase that, so you get better value of that money going in, and then it can decrease it by up to 15% to bring it back down to the $500,000 point. It won't go below the amount that is initially set up. So these are some of the options that are available with Universal Life. The other thing, of course, you're going to look at when you do Universal Life, there's a minimum premium, and that's the minimum it takes to for your clients to keep the policy in force for that year. That's the minimum premium that has to be available and paid. The target premium, that's actually what you get paid on for the first year. So that's an important number for you to understand what the target premium is. And I will talk to you about the how you do get paid on these later on. Your billing premium, that's what the client's going to pay. It could be anywhere from the minimum to the max. And the max premium is that kind of the amount, the MTAR level that they say you can only put in this much to be under the Tax Act. Otherwise, you're not going to get the tax benefits in that savings account, investment account. Don't worry, SHQ will monitor those levels for you. If your clients want to access the funds in that investment bucket, or in that investment in the insurance contract, they can choose a policy loan, they can make withdrawals, they can surrender the policy and get the cash values out. So that means shutting it down completely, or you can use collateral for a loan, right? Those are the options you can use to access the funds in that bucket. Be aware though, if you do surrender or make a withdrawal or a cash advance, that may be taxable. So we have to make sure before someone does that, I would suggest that you take a look and see what the adjusted cost base is, so we can make sure that the clients are fully aware that there may be a taxable disposition. But for the most part, SSQ and all insurance companies do a test on each policy anniversary to make sure that they meet the criteria of the tax exempt status for the interest earned in the UL product, because that's the key. And the investments in that bucket are tax exempt as long as we meet all the criteria. Okay, little commercial about SSQ and our key universal life features here. First of all, we aim to have a simple, flexible, and competitive product. And I know we have actually we've actually reached that. Those that do use us can confirm that we do have a nice, simple, flexible, and competitive offer for you. So let's go into some of those details here. Like all companies, most companies, we have the individual, the joint first to die, and the joint last to die offers for you. So lots of flexibility for your clients. You can do it individual, you can do it corporate as well, right? There are two types of costs of insurance, and here are the ages that you can set it up. I showed you these before, the yearly renewable term options. You can open up an account from age 0, actually 15 days, uh, to age 85. It'll take longer to get the social insurance number on that in place. But definitely you could open up a YRT from age 0 to age 85, and the T100 0 to age 80. I should point out that if you do have a product with SSQ, like a term product with SSQ, you can actually convert that at any time to this product or a whole life, one of our whole life, up to age client turns 71. So that's an important feature, that this is something that you can look at for your clients later on as well. Okay, so death benefit options for SSQ. Yes, with YRT, we have that increasing death benefit. So like I remember I said, the $500,000, 10 million policy here. So it can have an increasing option, or you can have a level with the accumulation fund. If once it surpasses the the coverage amount, you actually also then get that amount upon death. The key benefit here, you save on the cost of insurance because you're paying for less insurance, hence more goes in the accumulation fund. So this is very good for budgeting. On the T100 side of things, so we look at the death benefit, only level, so only increasing is allowed. So you do so basically you've got the insurance amount and then of course the amount that goes up on top of that for T100. We love our YRT. Our to age YRT. The way it works is because you do an increase. We do the YRT increases over time. However, at age 90, here ours levelizes. What we noticed on our research when we revamped our product and looked at it, a lot of illustrations blew up past age 90. And that's because that the cost of insurance continued to skyrocket up, and basically make the policies not viable anymore. So what we ended up doing was choosing age 90 and levelizing it after that. So when you see your illustrations, if you do get the SSQ illustration, you'll see that happens. So that's exciting, and that's part of it. Our goal is to insure people for life, right? With this product, to make sure that they have that insurance and it stays in place. Now, here's some research. We got SSQ and a few other companies, A, B, C, and D. And we actually did some illustrations and compared. And just so you can see the value, just don't take my word for it. You can actually look yourself as well. But the male 45 for $250,000, the cost of insurance compared to all these companies here, as you can see, SSQ, the value piece is there. And this is the driver for the value of SSQ for you. So okay, minimum 25,000. So really, you can start with a very reasonable amount for somebody. 25,000 minimum. That's one of the lowest in the industry for sure. You can go up to 10 million with our illustration software and play around with that. Of course, if you want a 20 million, up to a $20 million case, we've done a lot of these. Just ask us, talk to your wholesaler, your sales team. We will do a special for you. We're excited to do those. We have highly competitive commissions. So I did talk to you about your commissions, of course. So with year one, your YRT, right? I mentioned the target premium before is what you were looking at. So 65% up to the target premium with 5% on the excess. For level T100, we have 55% up to target premium, 5% on the excess. Years 2 to 10, 5%. And then after year 11, it's based on the fund value. So great value for your clients on their cost of insurance, great value for you as your business. If you do set this up, of course, people do there are surrender charges. So with T100, there are no surrender charges, whether they do a reduction in the insurance amount or if they surrender it. So T100 is zero. For YRT, there is a 7-year surrender charge process for the YRT. For YRT, partial surrender charges in the first 5 years if you do a reduction in the insurance amount. So that's a key thing with SSQ. Some of the great benefits you can add or that are included. When we say benefits at SSQ, that means they are included in the coverage. So you're not getting charged separately for these. They are there. They're in place. They're contractual. So basically, you can have a privilege in case of disability, and what that allows is that should you become disabled, and there's a few little criteria for that, of course, making sure it's verified, but allows you to access the cash in that bucket, that investment bucket, and you can access that tax-free to help you out. There's an extreme disability benefit, and I will highlight that on the next slide. There's an insurability benefit for children. So the insurability benefit for children is basically allows them to increase. And there's also a CI benefit for children. So one of my favorite pieces, things to promote at SSQ as a wholesaler is this extreme disability benefit, EDB, some people call it. And what it is, it's available on our term, our whole life, our universal life. It provides up to 50% of the life insurance amount, up to $250,000. No additional cost. So it is extreme. And it only covers you up to age 60. But if you cannot perform 4 of the 6 acts of daily living, it allows you to access some of the face amount. And really, the nice piece on this is that some people don't like to go through the disability process, or they don't qualify because of their type of work or where they go. This allows something in their policy that they have for extreme cases, right? It is 4 of the 6 acts of daily living that they cannot perform. It is offered on all individual insurance life products, including UL, increasing death benefit. Unfortunately, the level death benefit does not have that offering, but with increasing for sure with UL. Some of the other things, the children, let's talk about the kids. I'm always happy to promote benefits for children. The insurability benefit for children, they can increase their coverage amount up to $250,000. So should something come across their path, sadly, that we can then look at increasing their coverage without evidence of insurability. And of course, the critical illness benefit for children allows payment of 25% of the insurance amount up to $50,000. So free of cost if they get a CI, a critical illness. So free coverage for that, so that it can assure, basically helps you with your sales process, helps you protect the kids in the families that you're insuring. You can add coverage as well with a UL. So for $60, your $60 annual fee, of course you can then add term life insurance from T10 all the way up to T40. You can add a critical illness in there from T10, T20, T75, T100, paid up over 20 years as well for critical illness coverages in there. You can add a critical illness rider as well. That when I talked, the critical illness rider for $20,000 for 3 illnesses. And that's another highlight that I like to talk about with SSQ, the CI rider. And I will talk about that on the next slide. But some of the other coverages you can add is this child rider for insuring the children. You can do a waiver of premium in case of disability, accidental death and dismemberment, and benefit in case of fracture. So there's a whole wide variety of things you can add to your universal life quote for your clients. So the CI rider, I'm going to promote this because I think everyone should try. If your clients come in on standard, and SSQ will offer them this product, let you know as well, of course, and let you know on time of delivery as well that they qualify. So if they come in standard, they can qualify without any CI underwriting at all. So it's just the life underwriting. The CI underwriting is not part of the process for this. They come in standard, they qualify for life, and they get $20,000 lump sum payment in case of cancer, stroke, or heart attack. So it's life threatening, of course. And this premium is levelized up until age 85. So it's very reasonable. You can see at the male 35 non-smoker, $102 annual premium. So that's $8 a month. And that is levelized until age 85. So you can actually have that with your UL and it will cover them up until age 85. So something is better than nothing. It's a complement, but it's good to have in place. And if you want to go full CI coverage, you can do the full underwriting and the standalone products as well for larger amounts. I know my wife and I have this. Okay, so on to the investment options with UL. You remember here we talked about the deposits. You put the deposits in, it goes into the savings account, and then we talked about the monthly cost of insurance and the value there. Well, what investments do you have available, right? We want to make sure that we add value there as well. So I'm excited at SSQ to talk about our investment options. SSQ, like independent brokers, where you can pick and choose the best insurance companies for your clients and what products fit and who has the best of the best for them. SSQ strives to do the same on the investment side. So we only have independent fund managers that we work with. So we shop the market for the independent fund managers that are the best in each class. So we look to get we don't like to have redundancy, but we look to have the best Canadian fund, the best US funds, the best balanced funds, those sorts of things for you. And you'll get a sense of that as I move forward. When we talk about universal life investment funds, though, so a lot of people are comfortable with maybe mutual funds and MERs. Well, with universal life investments, there's actually a fee. So it's different. So we actually do gross returns. So you'll actually get gross returns on your investments into that bucket, and then the fee gets charged after. So when you look up the investments with SSQ and Morningstar and things like that, you'll see the gross returns going into that bucket. And then the fee is charged afterwards. Unlike mutual funds and seg funds tend to be net returns, less the fees, right? So I want to make sure that was clear. SSQ provides a very easy to understand guarantee bonus. So basically anything in that investment bucket gets an extra 1% bonus every year as of the 6th policy anniversary. So everything goes up 1% in that bucket every year. And that's year after year after, not just the one-time thing, it's every year moving forward, whatever's in that bucket. So that's exciting for you. So it's none of this, how do I get this bonus? What do I have to do it? Nope, you just have to have investments inside that bucket as of the 6th policy anniversary, and you will get that 1% bonus. Some of the most conservative investments you can have, of course, we have GIAs, similar to GICs at the bank. So 1 year, 3 year, 5 year, 10-year GIAs. The current rate right now on the 10-year is a 1%. The 1% can, of course, gets bonused up at the 6-year mark, so 2%, and that moving forward. So actually, I've got some quotes just with very conservative numbers for our UL, and you'll see that there's still value in using these for those most conservative investors. Most people, since this is a long-term investment, tend to want to invest in some sort of mutual funds or some sort of equities, not mutual funds, investments or equities. So SSQ is proud to have the synergies between their seg funds and, of course, the universal life investment funds that are available. So we have our strategy options for portfolios. So from conservative to aggressive, that's a fund of funds. You can see here that the fees for those are 2.75. If you're having a fee discussion with your clients, point out that the end of the 6th year, right? That 1% bonus is the equivalent of taking 1% off that number. So really, you're going to get a fully um, managed portfolio as aggressive as you want for 1.75% cost, which is competitive with most people out there. And I think that adds a lot of value. So a nice way to look at it as well. We also have balance funds with CI and Guardian as well, which I'm a fan of the CI tactical funds. If you want to add, not you just don't want to have just a balance fund for your clients, SSQ, this is one of our strengths. You can actually choose if, hey, we want to load up in bonds or global bonds, or you know what, the Canadian dividend space is about to turn around. Let's try that, or let's go into global dividends or emerging markets, or I want to focus on U.S. or global, or infrastructure or real estate. So lots of options for your clients to be able to move and select different aspects. You can work with them based on their KYC and their knowledge base and what they're looking for to get out of their investments. So those are managed funds. And then, of course, we have index-driven options for you as well. So if you want to just go into the Treasury bill market or the S&P or the MSCI International Equity Fund or emerging markets even, so you can actually just do you can actually invest in index driven. So as you can see, a lot of options for your clients when it comes to investments. All of this information is available if you want to research those investments. By all means, go to Morningstar, Fund Data, Canex, Globe Investor Funds, even the SSQ advisor sites. You can log on there and take a look at them as well. And you can email these to your clients as well for disclosures these days. And you'll get a complete breakdown of geographic and sectoral breakdowns, as well as the historic reporting. Yeah, a lot of resources for you on that. So I think you'll be pleased with that bucket and the options that are available for investments for your clients. All right, so that was a lot in half an hour. Now we're going to spend the next half an hour going over some sales ideas with Universal Life in mind. Well, let's start here. So nice and simple study here. So we've got a male, age 35, has a T10 for $500,000, $500,000 with SSQ, and it's coming up for renewal in a couple of years. Talk to the client. What can we do? Well, they of course they look at the renewal, and they might say it's a little expensive for them. You could, of course, shop the market as well, needing new underwriting. Are they insurable? Is it rated? Is it deferred? What are they doing in their lifestyle? That sort of thing. Or you can look at convert. You could also look at converting this, of course, to a UL. We even have a whole life you convert to. But today, because we're talking about UL YRT, we're going to look at what is it going to cost this person to kind of just convert this to a YRT UL. So we do a quick illustration, and here we are. Of course, $500,000 coverage. There's the $60 policy fee. Privilege in case of disability is included in there. And for $70, that's the billing premium. Minimum is $65, so $70 a month. That's what we set him up for. So he feels he can afford $70 a month. And frankly, it doesn't illustrate to age 100, but because that's what he could afford with offering the flexibility, this actually stays in place until he's almost 60. Right? Remember, he was 35, and just at $70, you can see the base funds here are growing a little bit and then reduced to zero. So he could keep paying and increase his payments at that point to keep it in force or reduce, you name it. It's a nice flexible product for your client. And we're illustrating this at 1%. This is that 10-year GIA, right? With and the 1% bonus at the 6 years. So a very conservative illustration showing the value of the cost of insurance and with YRT UL, what it can add for your client. I'm going to tell a personal story right now. I've just had an experience with the YRT UL with, unfortunately, my dad recently passed away, and he had prostate cancer for 25 years and succumbed to that just this year. And we were going over his will and that with the family back at Christmas time because we knew his time was coming. And my mom and dad, they mentioned, oh, and that we were looking at the will. They said, well, we've got the life insurance. I said, oh, we have life insurance for dad? Because I know he's been diagnosed 25 years ago, right? And so show me the policy. So they showed me the policy, and I know what has happened over the last 30 years with our family. My dad's an entrepreneur. He started a business. He had to close it down. Lots of ups and downs with income, things like that. And we had all the policies there. And yeah, they started out with a term with a good insurance broker who worked with them to get it affordable. And so he was well protected while we were a young family. And then that just evolved over time. And eventually to a YRT UL, where he would keep paying. He took money out of it when he needed it. And at the end of the day, it paid out to help my mom. It wasn't a lot, but it was definitely enough to help her with final expenses and to kind of this next year or two to kind of help her resettle. So these things they are flexible, and it's similar to what this example is. Start off with term, and then who knows what happens in life, right? You convert, you can reduce, all sorts of things. So I see a lot of value in this. So my second case study is a corporate estate transfer. So think of this, a corporate UL. We have a male, age 40. The trick to all insurance is of course the insurability of the person. We got to make sure that our male, age 40, is insurable. If that's the case, then excellent. We've got lots of options for them. They want to do this person wanted to do an estate transfer. So he had extra funds in his corporation, and he wanted to put $25,000 a year, invested at say 3.5% to the age of 65. And in this case example, we're going to show what happens if he got a disability at age 55 and took out some money. And but the objective of this was absolutely to pass money through inheritance for beneficiaries. So with that in mind, how does that look? So here we are. We do a quick quote here. $1 million coverage, YRT. We've got the extreme disability benefit in there. We've got this privilege in case of disability included, free of charge. That's going to come into play with the next screens here. And we're putting $25,000 in every year for 25 years. That's what they want to do. How does that look? Well, here we are. $25,000 from age 41 to 65, 25,000. Here's we have a amount at risk, so we have increasing death benefit, right? So, and we have his surrender value of the cashier. Here, he received that disability and was able to take out $100,000 tax-free to help him through his disability claim. We continue on with this illustration all the way to age 100. Of course, remember, they stop paying. And of course, we don't know when or how long he's going to be with us on this planet. But here's the death benefit continues even at this 3.5%. We're just showing that we can get 3.5% rate of return. And because of the cost of insurance, that will grow and they continue to have the benefit. So as you can see, the life death benefit grows it peaks around here at around age 80 to 90, about 2.4 million, almost 2.5 million, which we know is life expectancy. for a male. Now we show him that, and he's like, "That's great, but I don't think that gets a sale. We know that doesn't get a sale, and we've actually have a whole presentation on this. Um, so let's do a comparison." And our software actually does this. It does a comparison between kind of hey, what if I just took the $25,000 and invested in my corporation and pass that along to my heirs? Well, traditional approach is you keep it in the corporation. You do get taxed on the income, right? Um, and the growth taxed is on death as well. You are able to make withdrawals for this traditional investment, this 25,000 for 25 years. On death, you liquidate the investments, you're taxed on the gains. Basically, less goes to the estate and more gets paid in tax. And then we propose, of course, our side of the world, the corporate asset transfer, is we're going to combine the insurance and investments together. So because of the Tax Act, we go no tax on the growth, tax-free on death. The capital dividend account gets credited, right, and used for that. We get access to cash value. So you can use the collateral loan, policy loan, or a policy withdrawal during its lifetime. Or on death, it is paid out tax-free, right, as long as the CDA is able to be credited and used. So more to the estate. Well, that's nice. What does it look like in numbers? Because frankly, you show that, and most business owners, that's great. Then we talk to my accountant. Well, we can actually run the spreadsheets for your accountant too. So they look a little bit like this. And here's the taxable investments are on this side. So here's if you did it the traditional way with 25,000 for 25 years. Here it is, 25,000 for 25 years. And then all the math that goes into that, including the RDTOH, which is the refundable dividend tax on hand. So accountants will love that. We don't have to know it. Basically, it's a notional account that says that you've paid tax on this money already. You're not going to pay again, so you get a credit for not paying tax when you cash out. So the key here is kind of this side over here, net estate benefit. We come out to this, the accountants are going to look at this, but really the conversation with the business owner and the accountant will come down to this. What is the net estate benefit? So day one, or the first 25,000 goes in, how much would go to the through the company to the estate? 14,000. And as you go all the way down here, all the way up to 1.6 million 45 years later, right, at age 100. Versus the insurance, day one, $1 million coverage, right? We've got over almost $1 million advantage from day one, and that stays, right? That $1 million advantage stays all the way up until the very, very end, and it's only $750,000 advantage at that point. You can focus on the percentages. What kind of rate of return is on this $25,000 that you're putting in? Well, compared to putting it in regularly, right? So you can over 1,000% better, and even at the end, 45% better. But from day one, so this is the kind of the key. And then of course the accountant will want to check all this out, and they will, and then they'll see the value in it. So that's in a quick nutshell what that is. I'm going to do two more quick ones here, and then we're all finished up. So a personal estate transfer. So this, so somebody who actually wants to put money personally to their estate, right, to help out the kids, to pay for taxes, to pay for the cottage, you name it. They realize, they talk to their accountants. Obviously, this is a wealthy person. They need $600,000, or they want to give money away, and they want to use the years they have left and some of the money they have to do good in the world once they pass. So female, 73, non-smoker, insurable, of course, wants $600,000, and also wants the lowest premium with guarantee rates. So wants no risk, little risk, and $600,000 coverage. Well, my friend Yusuf here did a search recently. What does that look like? Well, premium here annually, just over $21,000. Next closest is a 23,000, and of course it goes up to 27,000. So this person was looking for the lowest premium annually for them. So nice that SSQ conveniently for this presentation, SSQ shows up first, and they do, of course. Once again, just to point out the value of the cost of insurance savings. So we do the quote. Here's the quote, the real quote on the software to back that up. So once again, $21,000 is the annual billing premium for this client, and she wants to pay that to have a coverage of $600,000. And here's what the illustration looks like. So from age 74 all the way to age 100, she continues to pay the $21,000. We're illustrating it here at 1%. Remember, just the GIC rate, 10-year guaranteed 1%. Plus, you get the 1% at the 6-year mark, as I talked about, the bonus. So this will be in place for 27 years. You see the base fan values go up and then go down again to 0 to match that, so it's all set. What happens though down the road? What happens if she were to all of a sudden maybe diagnosed? We're going to say she was diagnosed with a degenerative disease with only a few years to live. Well, so that's at age 80, we said. So after 7 years, well, a few things you could do. You could, of course, surrender it and take out the cash value. But that's not what the purpose of this for. This was for the estate to do good things in the world, to add for their kids, for charities, you name it. They were going to do that. She wanted to do that. So if that was the case, she could stop. You do a quote. We could stop, and actually this would continue to run for 6 more years without another dollar going in, giving her 6 years. So it depends on the diagnosis, of course, and how dire it is, sadly. But she would have that peace of mind that it would be going to the estate, and then to the whoever she designated it to go to. So lots of flexibility with UL, right? Okay, last one, we're going to talk about a child UL YRT, and this is just to demonstrate how inexpensive it can be to insure a child or in the early days. So we have a young female, a girl, five years old. $250,000. What does $250,000 of insurance cover? They've got a budget issue. What is the budget? How much will it cost for that? And we're basically going to do just a minimum premium with a 1% guarantee rate. Once again, I'm not quoting 3%, 3.5%, 4% rates of returns. 1% guaranteed, just to highlight the cost of insurance value. So here we are. So we've got the quote, $250,000. I told you about the extreme disability benefit. So if she's disabled, she can access up to that amount. Extremely. There's an insurability benefit. There's a CI benefit of $50,000, all included, right? These are all included, so no cost with all these things included in there. Just about $22 is the monthly billing premium, right? Minimum is that, so that's what we're paying, about $22. So $22 a month. How long does it last? Well, it doesn't go to the end. But for $22 a month, it could be a grandparent, parent paying this, you name it. But for $22 a month, they have that death benefit. And you can see after the first year here, they only have $16 extra in that bucket. But because of the cost of the insurance, it just kind of stays the same and goes up. And actually, it lasts all the way until they're that young woman of 41 years old is in the world. And of course, so many things can happen in the meantime. We've locked in the insurability. At this point, they could be having a job, working on their career. They could take it over, put their own money in. There's so much flexibility in that. And once again, we're just illustrating at the 1% right now. So hopefully that highlights how inexpensive it can be to get children insured, right? And they have those other benefits as well, including a CI benefit. All right, so the last few slides here, I see we've got about 9 minutes left. I will go to the advisor sales tools and wrap up. So first of all, if you don't have our illustration software, go to your MGA, they'll have access to it, or you can just Google SSQ illustration software or go to ssq.ca and you can access it, download it, and then you can play around with it. This is our UL, you click on UL and do that, or the term. You want whole life or T100, you want a standalone CI. The library is the key. A lot of these, this presentation with all the little graphs and about UL, we have some very good pieces, marketing pieces on that for you. We have the sales concepts, so that sales concepts here for the corporate UL they're all in there as well, and of course some financial calculators. So this is where you go to for anything SSQ on the insurance side. This is a great place to start. And then once you're contracted, you can have access to our secure side as well to monitor your policies and manage them as well. The marketing documents, here they are. So I showed you the picture of my bucket. That's in there. All these charts that we talked about today, the investments, you name it, Universal Life at a glance, it's all there. So should you want to have that at hand or on PDF, definitely you can get those from SSQ, or you can look at them on your screens these days. So your next step with SSQ, when you're looking for your insurance needs for your client, please do consider Universal Life as a solution. At least it's worth at least a look. If you need some help, by all means, reach out to our SSQ sales team. We're here to help you with that. We'll teach you what the software is all about. Hopefully, we can have a sit down with you in the future. For now, we'll have to do lots of virtual things, but it seems to be everyone's coming to terms with that. But hopefully in the future, we can have a sit down together as well. So connect with them. Stay tuned. We have some marketing material for clients with Universal Life coming up for you. So you can actually have a little bit of you can put a sales kind of spin and send out some teasers to your clients. Hey, have you considered this or that? Or have a conversation and then have something to send them to reinforce that message that conversation you've had with your clients. And with that, I think I'm finishing up about 5 minutes early here. Once again, your CE credits will be issued in the coming weeks. So don't reach out to us and say, hey, where is it? Where is it? Where is it? We're definitely working on that, and we will get them to you in a few weeks here. On behalf of SSQ and myself, Paul Grunsel here, I just want to say thank you for your business and thank you for your time today. It's an honor and a privilege to be here and talking to so many people virtually. It's a very cool thing. I know I'm going to be talking about this a lot of people for a long time. So thank you for your time today, and stay safe and have a great rest of your day and week. Thank you.